So hello, everyone. Thank you for joining. I'm Katie. I run marketing and community here at Right Side Up. And I am absolutely thrilled to turn the mic over to Jess Parker, our writer and editor and longtime independent consultant herself. She's been working closely with Mark to put this session together for all of you guys. And it's a very highly requested session. So we hope you enjoy. And with that, I'll turn it over to Jess.
Thanks for that intro, Katie. Hey, everyone. As she said, I'm Jess Parker, writer and editor here at Right Side Up, and we're so glad that you're joining us today. So for the handful of you who aren't familiar with Right Side Up, we are a collective of growth marketing specialists who have helped more than 300 VC-backed tech companies hit their goals. We cover virtually all paid channels, including SEO, CRO, email marketing, analytics, and more. Today's webinar hits on a very important and very timely topic, how to handle taxes as an independent contractor. Many of the people on our team are first-time consultants who have spent most of their careers in-house as W-2 employees. And while they're definitely experts in their specific areas of growth marketing, dealing with 1099 income at tax season requires a totally different set of knowledge and probably a good CPA. So that's why I'm pleased to introduce you to Mark Edler, our accounting manager at Right Side Up. He holds his certified public accounting license in Pennsylvania. And before joining Right Side Up, Mark spent time at PricewaterhouseCoopers with a tax consulting group that specialized in data analytics for corporate clients. Mark is passionate about helping entrepreneurs save time and money through sound accounting and tax planning, and that's what he's here to discuss today. Mark will walk us through important tax documents, helpful bookkeeping software recommendations, money-saving tax deductions, and what your options are for setting up a legal entity or retirement plan as an independent contractor. So before I turn it over to Mark, I'll just mention a couple of important housekeeping items. First, please submit any and all questions throughout the session using Zoom's Q&A functionality at the bottom of your screen. We'll plan to address as many questions as we can in the last 20 to 30 minutes. And we're also recording this webinar, and we'll share the recording and the slides with you via email within the next few days. So that's it from me. And Mark, you're free to take it away.
All right. Thanks, Jess. Thanks everybody for joining us today to talk about taxes. We're going to go over what you should expect to see on your tax return as a freelancer. We'll talk a little bit about how to make life easier before the tax deadline and a little bit of tidbits of tax strategy for freelancers and business owners. Please also just note that this presentation is going to mostly go over federal income tax. Obviously, there's different tax laws for each state as well as international. But this should cover the chunk of what you need to know. One more disclaimer, this webinar contains informational content and is not intended to serve as legal or financial advice from Right Side Up. You should definitely consult a CPA or another tax professional for specific advice about your individual situation. So here's our agenda for today. We're going to start with some COVID updates for 2021. Not all of those will be relevant for 2022, but important to know if you haven't filed for this year. We'll go over some record keeping items, what documents you should be looking out for, and a couple of recommendations on software. We're going to talk about deductions that'll bring your taxable income down. We'll talk about whether you need to make tax estimates or not. And then we'll dive into some fun stuff like implications of LLCs, as well as strategy for investments with retirement, and then some time for Q&A. So I was already introduced, so this is me. This is a little bit about Right Side Up, which is already touched on. So we'll start with COVID updates. So a couple of things for 2021. Big item this year was there was an update to the child tax credit. So this was actually increased in 2021, and basically you used to be able to get up to $2,000 per kid, which is a dollar for dollar reduction in your taxes. This year in 2021, you're able to get $3,600 per kid for ages 1 through 5, which is reduced to $3,000 for children ages 6 to 17. You should also definitely note that this child tax credit was actually partially paid in advance during the year if you have children. Depending on your income level, which is actually going to reduce the amount that you get credited on your tax return. So there's a lot of people this year who were surprised to see that they are getting a lower refund than previous years. EIP3, so this is just the economic impact payment, the third stimulus check. So if you didn't receive this stimulus check, you're going to want to just double check that you might be eligible. If you are, you can claim it on your tax return. You can, save on some taxes. And last item, if you took out a PPP loan for your business through your LLC, if you had that forgiven in 2021, that should count as taxable income. So a lot of you probably don't need to worry about that, but just something to keep in mind if you took advantage of that. Cool. So first thing, most of you are probably familiar with a W-2. If you're new to contracting or freelancing, you may not be as familiar with the 1099, but both of these documents serve the same purpose. These are basically to show you how much income you receive from either your employer or a customer during the year. So big thing that you're going to notice is that a W-2 is going to have all these different boxes for withholding. Basically, your employer will withhold federal income tax as well as Social Security, Medicare, and other types of taxes for you, whereas 1099 is usually just going to have that box one, non-employee compensation checked, and there's not going to be any withholding. So like I just said, you're going to see a bunch of taxes withheld from the W-2, which is, to your advantage at tax time. You're not going to owe as much. But obviously, many of you are joining to go over 1099 income, so you'll see here. So, obviously, there's a bunch of taxes that are not withheld. So basically, you're going to want to take all your 1099s from during the year and sum them up and make sure that you are reporting all that on Schedule C. And definitely note that if you were paid less than $600, the company is not required to send you a 1099, but you should still file it on your tax return. You should still file all your income. So record keeping best practices. I think this is where a lot of freelancers get kind of hung up, especially when you're transitioning from maybe being a full-time employee. So it's definitely important. I think it's a good idea to use software to organize your income and expenses. The big one is QuickBooks. I'm going to go over one other software that you can use to put your records in one place. But ultimately, this software is going to enable you to categorize your expenses throughout the year and keep track of your income. And I'll go over some other quick tips on how to make that easier. But ultimately, when you're using a software like this, basically the advantage you're going to have is it's going to allow you to capture all of your information in one single profit and loss. So as long as you're plugging in everything into your software correctly, you're going to have a clean summarized report at the end of the year. And I'm going to touch on this momentarily, but most software platforms will be able to import your bank feed rather than you inputting every transaction throughout the year, which can save you a lot of time on doing your accounting. So the big industry standard for freelancers and for many small businesses is QuickBooks. It's pretty user-friendly. It has a lot more capabilities than most freelancers need, but they do have a freelancer version that's, I think, only $15. It's going to give you the ability to use real-time reports and dashboards. And the other advantage is that if you're using an accountant to file your taxes at the end of the year, most of them are already set up with QuickBooks, so it's going to be easy to share. It's going to make your life a lot easier. Bonsai is another newer software that's out there. This is really an app that's used for freelancers for all types of organizations. So they have different items to help you keep track of projects, to track your time. But they also have some added functionalities in tracking income and expenses and also estimating taxes. It's a little bit more expensive than QuickBooks, but it could be a good alternative depending on what you like. You're going to miss out on some of the more sophisticated accounting functions because this is not necessarily accounting software. But for most freelancers, I don't really think that's the main purpose. This also doesn't have bank reconciliations, which is a big feature that you're going to want to use to make sure that you're not missing out on any of your expenses. Cool, so we're going to go over some deductions. We'll go over Form 8829, which is the home office expense, and I'll also quickly touch on QBI. So what can you deduct as a contractor? This is the big question, right? This is how you're going to get your taxable income down. So generally, these are the expenses listed here that are going to be relevant for, a marketing consultant or really any type of freelancer that's working from home. So anything that is considered necessary and ordinary for your business is going to be deductible. So, things like a computer, a phone, any type of software that you pay for, paying for your Wi-Fi, your internet. Meals are half deductible if they're related to business. I would not write off all the food that you eat at your house if you're working from home. But related to home office expenses, you can write off expenses for your home office. So things like furnishing, supplies, anything that's in your office, you can deduct completely. And then we're also going to go over later some of the items that can be prorated for your entire house, prorated by the percentage that you get to use your house. So the home office deduction, this is basically, you're able to take things like rent, your mortgage interest, your property taxes, home insurance, anything that's relevant to your house. You can take those expenses and then basically multiply them by the percentage that you use your house. So if that's, your office takes up 10% of your house, you have $10,000 of home-related expenses, you can take 10% of that. And that all goes on Form 8829, which will flow through to the Schedule C. The qualified business income deduction. So this is not something that you have to directly calculate. This is typically going to be calculated in software in your tax return, but I thought it was important to note that as a freelancer, typically 20% of your net income is going to be deducted from your taxes. And this was put in place basically to keep small businesses and freelancers in line with the corporate tax decrease that was put in place in 2017. But just important to know. So tax estimates, this is probably one of the items that most freelancers consider the scariest. Nobody wants to be in the dark about how much they owe at the end of the year. And figuring out how to make those estimates can be pretty complicated. So we'll touch on that. So obviously, as we mentioned before, if you're a W-2 employee, this is not something that you have to worry about. But basically, as a freelancer, you're going to be paying all of your taxes on your own. Whereas if you're an employee, some of your taxes are going to be paid by your employer. So with FICA taxes, the self-employment tax is about 15%, and that's not going to be withheld anywhere. So that's all going to go on your tax return at the end of the year. Whereas, with an employee, you're going to be paying that on every paycheck. So this is the biggest variable that tends to create a liability at the end of the year for freelancers. So the way that you want to protect yourself from this is by making quarterly tax estimated payments. So I'm going to give you a couple rules of thumb and help you understand the impact of making estimates. In general, you're expected by the IRS to make estimates if you anticipate owing $1,000 or more at the time that you file your taxes. If you don't pay throughout the year, there are penalties. It's about 0.5% of the balance per month. So it's not extremely significant, but it's definitely something that you want to avoid. There are also safe harbor penalties that will basically waive any late payment penalties as long as you paid a significant amount of your taxes throughout the year, or if you paid as much as you paid last year. So it's good to know. You don't need to know exactly how much you need to. You don't need to know exactly how much you're going to owe, and the calculations can be pretty confusing. But just overall, it's best to make some amount of estimates rather than none at all. And I would say your best bet is to work directly with an accountant. Most of them have software with their tax preparation software that will basically give you a better shot at making your estimates. This is also another reason why bookkeeping is important. If you're using QuickBooks, you can look at how you're doing throughout the year. If you're making more money than you expected, you can definitely, have more information to make a better estimated payment. So LLC implications. This is definitely a big one that comes up related to taxes. There are several benefits of setting up an LLC. I think the most important thing to realize is that an LLC primary function is to protect your liability, your legal liability, rather than actually changing your tax situation. This LLC shield is basically meant to protect you and separate you from your business. In the event that you make some type of mistake or there's some type of issue with your business, you don't want your personal assets to be at risk. So that's the important part of an LLC. And then we'll touch on tax savings in a bit, but it's important to realize that if you file an LLC, you're still technically paying taxes the same way that you would if you were a sole proprietor and never filed an LLC. So if you file an LLC, there's basically going to be an election that you make when you file it. So these are the three different types. So a sole proprietor, as I mentioned before, will also be called a disregarded entity. And this would basically mean that you're paying the same exact amount of tax. You're filing the same tax return that you would if you never filed an LLC at all. So everything would still go on a Schedule C. You can also elect to file as an S Corp. So if you do this, you're going to file a completely different tax return. It's called an 1120S. But ultimately, those income and expenses are going to flow through to your personal taxes. So an S Corp does not change your tax rate on your ordinary taxes. And then there's C Corps, which are also a separate entity. And those entities file their own tax return and also pay their own taxes. And I'll say for most freelancers, a C Corp is definitely not the choice that you want to make. I'm really just including it here for informational purposes. But there's double taxation, which are other complicated things that happen with C Corps. So the first two are most likely what you're going to stick with. So this is just a little summary of the things that I touched on earlier. But I would say for most freelancers, you're definitely going to want to set up an LLC. It's pretty cheap. It's not difficult to set up. There's no required shareholder board structures. Everything pretty much stays the same. You just file a couple of documents. And as far as elections for taxes, I would say typically most people are okay staying as a disregarded entity. It really depends on how much money you make. There are savings that you can create on self-employment taxes if you elect an S Corp, but it's definitely something that you would want to discuss with an accountant. It can be pretty complex, and you definitely don't want to mess up the selection at the beginning because it could end up in making a mistake and owing penalties or back taxes, which you definitely want to avoid. So we'll touch on some retirement options. These can be really good strategies for freelancers who might be making a lot of money and owing a lot of taxes. So if you're in a high tax bracket, some of these retirement accounts can help you defer taxes until later. So we'll touch on these. So if you're a sole proprietor, you can contribute to a traditional or Roth IRA. This is available to any individual. It's $6,000 is the max contribution for 2022, and there's a catch-up amount up to $7,000 if you're older. These are typically pretty cheap to set up, and there's not really much restrictions. Solo 401k, this is Tends to be a little bit more administratively expensive, but you can also defer a lot of taxes by contributing up to about $20,000 on the employee side, and then there's also an employer match where you can contribute extra. Keep in mind that there's also restrictions. Basically, with your LLC, you should make sure that you don't have any employees. Otherwise, there's testing that needs to be done to basically make sure that everyone is being given fair access to the 401k plan. But for most freelancers, it's not going to be an issue. The SEP IRA, so this is similar to the solo 401k. It tends to be a little bit cheaper to administer. You can defer up to 25% of your compensation or $61,000, whichever one's smaller. Keep in mind that contributions must be made to each employee at the same percentage of compensation. So again, not something that you have to worry about if you're a single member entity with no partners, no employees, but it can get complicated if you either partner with somebody or if you have somebody on payroll. So just something to keep in mind. A simple IRA is similar to a SEP, but basically the employee makes the contribution, and then employers have to match a certain percentage of that. And then there's also the defined benefit plan, which lets you contribute up to a max of 100% of your compensation or up to $245,000. And that's usually a pretty expensive one to administer. And also keep in mind that the employer would make all the contributions to this one. So keep in mind, obviously for freelancers, you are the employee and the employer, but basically just the main difference is which side you're gonna write the check from. And following those rules can be a little complicated. So I would definitely suggest again that you talk to either a financial professional or a CPA. If we have any questions, we can jump to that, Katie.
Awesome. Yeah, thanks, Mark. That was great. So much information. And we already have a bunch of questions coming in, so I will help moderate those. So the first question is asked by Alvin. Alvin wants to know if there are income limits that make you ineligible for QBI.
Yes, that's a good question. Let me jump back to this QBI screen. So there are income limitations on QBI. They change depending on whether you're single, married, and forms of income. So I can definitely add some notes afterwards, include it in the slides on how to determine that. There are also there are some specifications for QBI where, depending on the type of business that you are, you cannot use this deduction. So the abbreviation is SSTB, and that's basically a specified service or trade business. This is usually like lawyers and accountants. So most freelancers, you can still take the QBI. I would definitely recommend, again, talking to a CPA or your specific tax advisor to double check that you qualify. But most small businesses are able to get this deduction.
Cool. And then we have a question from Connor. So if you're doing consulting work with a spouse, would a joint LLC make the most sense, or elect as an S Corp where they'd both be paid? And I know that's kind of a tough one. That's also like legal entity stuff. So
yeah, so I'll approach this from the tax side rather than from the legal side. I mean, it really depends. The main thing that you're going to want to consider with an S Corp is the amount of income that you have each year. So if your income is significantly high and you are able to pay yourself on a payroll, because that's part of the role with an S Corp, you have to basically pay yourself a reasonable compensation. Then an S Corp could make sense for two people. The partnership is probably less risky and easier to maintain. But either way, you're going to be filing a separate tax return from your personal return if you have two people in one LLC.
Cool. Thanks, Mark. So we have another question here from Kristen. A client paid her via ACH and then also credit card, and the 1099 NEC only had the ACH payment, which she understands the reason why. However, the question is, does she lump all credit payments together in her taxes on the 1099K? So pretend 10,000 total, or should she line item them? So there would be, say, 2 line items for that client, one under the 1099 NEC and one under the 1099K. So 900 client 100, or sorry, $900 client 1, $100 client 2. That makes
Gotcha.
sense. I know it's
Okay.
a long one. I could read it again.
So yeah, I'm going to answer. I think I understand what you're saying. So basically, what's going to happen when you get your 1099s is, you'll get all the 1099s that have the ACH payments, like you said. The reason that the credit card payments are not included is because, like you said, with the 1099K, those credit card processing companies are mandated to report that income anyway. So ultimately, when you're filing on a Schedule C or whatever your return is, where you have this gross income, I would say that it's okay to combine all of these in line 1.
Thank you. Cool. And Kristen, let us know if that answered your question there. We've got a couple of questions on IRAs, but we'll save those for a sec. So Rishi has a California specific question mark. So I'm not sure that this is within your realm of expertise, but he's asking what's up with the California sourced income for non-residents. Mentioned he's gotten hassled by the California FTB about this, but lives in New York and already paid New York state taxes.
Gotcha.
Do you know anything about that?
Yeah, so I'm not familiar with California specifically. All the states have different rules, but I will say that typically, if you have to pay a tax in another state for some reason, typically you can avoid double taxation by taking a credit for taxes paid to other jurisdictions. So with California and New York rules, it's going to depend on what their laws are, but most states will follow that and basically let you reduce your taxes on one of those state tax returns.
Cool. Thank you. Great. And then someone has a question about tax software. So what tax software do you recommend if you have any recommendations? So TurboTax is one that he recommended. Anything else that you'd keep on the short list, Mark?
So for tax software, the only one I'm really familiar with for people filing their own tax returns is TurboTax. I can't say that I endorse it or love it, but I'm familiar with a couple others, but they're really professional tax softwares.
I think like
I would say
HR Block is another one. I feel like my husband and I used, but that was before I was 1099 and before our taxes were crazy complicated. So I'm not sure how well it would work for, if you have more complicated income sources.
Yeah, most of them tend to do a pretty similar job. They have a similar workflow that asks you some questions, you put your numbers in, and it'll spit it out. So I would say H&R Block or TurboTax are pretty sufficient for most people.
Cool. Great. Okay, switching gears a bit. Kate asks, am I contributing to Social Security when I pay my estimated quarterly taxes, or do I need to keep track of that separately? I've heard that self-employed people can get burned on Social Security later on.
Yeah, it's a good question. So your self-employment tax, let me go back to this slide.
Sorry, I keep making you jump around. I'm trying to group them together.
No, that's okay. So yeah, basically your self-employment tax includes your FICA taxes, and part of that is your Social Security tax. So when you pay your taxes as a freelancer, you are still contributing to Social Security. Now, if let's say you had no income after you wrote off all of your expenses and your home office and contributed, to take your taxes down, then you're not technically paying FICA taxes anymore. So that would be a situation where your total contributions to Social Security would be less.
Cool. Mark. Okay. How much should we set aside each time we get paid without an LLC? I know it's,
Gotcha. That's a good question.
yeah.
Yeah, so it typically, it depends really on how many deductions you have. Now, I'm going to assume that most freelancers in space, people working for Right Side Up, probably don't have a ton of expenses. It's a pretty light business. So, I mean, your self-employment tax on its own is 15%. And then your ordinary tax, you have to remember you have federal ordinary tax and also state income tax. I would conservatively say that putting aside between 30 and 40% of your income for taxes would be pretty safe.
Cool. Thank you. And then we have a question around LLCs. So George asks, would it make sense to have an LLC even if we get paid by Right Side Up? And Mark, I'm sure you have an answer for this too, but I know generally we do encourage all consultants to form an LLC. I mean, as Mark mentioned, it offers that liability protection. There's the reduced risk of a tax audit and ability to share member interest too. So Mark, is there anything else you'd add to that?
No, I think you said it perfectly. I definitely think an LLC is a good idea from a liability perspective, and it's not going to hurt you tax-wise. And Right Side Up or any other company will have the ability to pay you directly to your LLC. So I definitely think it's a good idea.
Cool. And George, and for everyone else really too, we did a webinar late last year, sometime in the fall. I want to say it was September, that like really got into the nitty gritty about legal entity formation and what the pros and cons were of each. So that's available. The recap's on our blog, and then it links out to the webinar itself from that blog post if you want to watch that on demand. So that might be a helpful resource for you guys too, if you want to look at that again. So that's just a note there. More questions coming in. Let's see what we got. Let's answer some of these IRA ones. So Lindsay asks, for simple IRAs, is there any tax benefit to the employer when making a match?
Yeah, so with any of these IRAs that have an employer contribution, that's going to count as a deduction towards the business taxes. So definitely a benefit there.
Cool. And then for the Roth IRA, are there any income limits worth noting?
Yeah, so there are income limits for the Roth IRA. I think it's around, I'll have to double check this, but I think for married filing jointly, it's around 130,000.
Okay.
I can put that in the notes afterwards, but yeah, there's definitely income limits to be aware of.
Okay, great. And then we had another one for the retirement options. If you're contributing to a company 401k, the yearly limit applies to self options, right? So, well, I'll pause there.
Sorry, could you repeat that?
Yeah, for retirement options, if you're contributing to a company 401k, the yearly limit applies to the self options, right?
Right. So that's a good question. With any type of 401k, so even though the name of the solo 401k is different than a employer sponsored 401k, you're still going to have the same limitation as an employee in aggregate. So if you contributed the max to a company that you're working for full time, the solo 401k option is probably not a good one for you.
Okay, great. And so the other related questions there from the same person, is it the same for the IRA options? Roughly, if you already have a 401k from work and a Roth IRA, which self options make the most sense?
Yeah, so again, I'll put this in the slide notes, but for 401k or for the IRA, the limitations are going to be in aggregate. But yeah, the self-employed IRA options definitely give you a higher limit. So typically those are the ones that you're going to want to take advantage of. But keep in mind that the limits are based on your business income, not your total income from your employment.
Cool. Okay, great. Switching gears a bit away from retirement savings. So we have someone who's asked, what's a reasonable percentage of self-contribution for an S Corp?
I'm assuming that's talking about a reasonable compensation for wages.
I think so.
Yeah, so that's a great question. There are some resources out there that kind of like will point to historically how much people pay themselves in each industry. Typically, like what I've seen is people pay themselves around $50,000 to $60,000. And then, like assuming, like let's say assume your business has a net profit of 100,000 or 110,000. Usually, you're going to end up somewhere between 45,000 and 60,000 being paid in wages. Anything else is going to be considered aggressively low. Obviously, I think anyone would agree that if you're paying yourself close to minimum wage or less, it's probably not reasonable. And if you don't pay yourself a reasonable amount, the IRS has the ability to basically come back and say, you should have paid yourself this much wages, so now you're going to owe this much in back taxes.
Cool.
But again, definitely one to check in with an advisor on your specific situation.
Cool. Thanks, Mark. So we have a question about affiliate payments. So are affiliate payments treated differently from a tax perspective? This person says, I've seen in some cases the company sends a 1099 and in other cases no documentation is sent. So we've always assumed the entire amount, regardless of 1099, should be submitted on taxes, but we're curious if you have any thoughts on this.
Yeah, that's a good question. Typically, they should be treated the same. It's going to be considered ordinary income. And like we touched on before, there is a basically minimum threshold where if you made less than $600 from a company, they don't have to file a 1099 for you. But I would definitely say you should treat affiliate income the same as your other ordinary income.
And I'm just skimming to make sure I've gotten all the questions that have been submitted so far. We actually had another one come in here. Can I take advantage of tax deductions and other tax benefits via my LLC if Right Side Up currently pays me directly, or would I need to make adjustments so Right Side Up pays my LLC moving forward?
Yeah, that's a good question. I would say that you can still take advantages of those deductions. I think the important thing to realize is that you can really file those deductions whether you're an LLC or not. So if you've been a freelancer, they're going to go on a Schedule C anyway. I think the important thing to note is that if you're not being paid to an LLC, if you are being paid to an LLC, you're going to want to make sure that you have a Schedule C that has your LLC EIN on it, that reports that 1099 correctly to that entity, because the IRS is going to check to see that each entity, whether it's you as a person or the LLC that you set up, is reporting that income correctly.
Cool. Thank you, Mark. Okay, and then we have another one here. Is tax rate based on the type of business services being rendered, or are small businesses under that 2017 change to 21%?
Yeah, it's a good question. So I guess if I'm understanding correctly, all businesses, regardless of what industry you're in, are going to pay the same income tax. But the difference is the type of entity that you choose. So that 21% tax rate, that's really only going to apply if you have a C corporation, which is going to be the one that I touched on in the slide and said that you probably shouldn't elect to be a C corporation. Anything else, sole proprietor, S corp, partnership, you're going to pay the same ordinary tax rate that you would pay on your personal taxes.
Cool. Thank you. All right, we already answered that one. When you do your 2021 taxes, do you file your business taxes and individual employee taxes separate or together? And well, I'll let that stand. Is that clear? Do we need clarification?
That's a good question. Okay. So if you have business income and expenses and you haven't made an election to be an S corp and you don't have a partner that would require you to file a partnership return, then you're going to file the income on a form. It's called a Schedule C. And that Schedule C will be a part of your personal taxes. So it'll be attached to your 1040.
Thanks, Mark. Let's see. I think I've got all of the open questions that have come in so far. So if you guys have been sitting on a question that you've been dying to ask, now is the time. I'm just going to scroll back through too to make sure I've got them. Got all those. Good, good, good. All right. Give it another minute or so to see if any more questions trickle in.
Well, I think one thing we can go over in the meantime, we're waiting to see if there's any other questions. So we did put this example profit and loss in here.
Awesome.
So basically, this is going to show you, I mean, this kind of just outlines the sample income and expenses that we noted earlier. One thing to note just for record keeping purposes is that you're probably not going to put your home office expenses in your accounting software. I would keep those separate. So as like a record keeping, just keep your bills for your house separately. And then when you get like a 1098 for your mortgage with your property taxes, you can kind of just lump that all together to file separately. Because if you muddle them up, you're going to have a hard time figuring out what should go on the home office form versus your ordinary expenses.
Cool, thank you. Yeah, the P&L statement can be nerve-wracking. I had to do that for the first time recently for our mortgage. It was yeah, definitely helpful to have a good CPA who knows what they're doing to help you put that together. This is a great question. How do we hire Mark as our tax advisor? I should answer that one and say we're keeping him very busy one. No, I don't know. Any comments on that, Mark?
I'll take it as a compliment, but yeah, not for hire right now.
Oh man, cool. We do have a couple more questions, or at least one more trickled in here. Cool. Do we need to keep paper copies of all receipts, or do digital copies and screenshots suffice? That's a good question.
That's a good question. Yeah, I would say digital copies are sufficient. I would make sure that you have them backed up somewhere. And actually, a good thing to note is that if you use QuickBooks, you can actually attach your receipts to like the expense line item directly. So you can use that as your kind of your record keeping.
Cool. Great. All right, guys.
And yeah, probably to add to that, I would say, I meant to put this in the slides. I think I actually forgot, but the IRS basically will expect that you keep your receipts around 3 years from when you file your tax returns. So just something to keep in mind.
Cool. Yeah, that's a great timeline to notice. Definitely easier with digital, but I mean, gosh, can only imagine how crazy the record keeping was back when everything was paper.
Yeah.
A lot of filing cabinets. Cool. All right, we got another one here. Cell phone. How conservative do we need to be on deducting?
I would say if you use your cell phone for business, which I think pretty much everyone does, especially considering you have probably your email on it, you don't have to prorate your phone for businesses. You can put the phone bill on your expenses.
Cool. That's good to know. Anything else, folks? What else is on your mind? Mark, what's like the most common question you've gotten from your time as a CPA?
That's a good question. I get a lot of stuff about the LLC. I think a lot of people automatically assume that filing an LLC will help you write off more things for your taxes, which technically really isn't true, although it is beneficial.
Mm-hmm.
I've gotten some crazy questions about people wanting to write off stuff for like their pets and all kinds of fun stuff.
I wonder how
they're not deductible.
Yeah. Wonder how they'd swing that. We have another question here around deductions. So if I take a client to an event, is that considered tax deductible?
So yeah, there's kind of a gray area between that. typically anything that's considered entertainment, like I said right here, is not going to be considered deductible. There are, you know, there are things that can be considered gifts or can be considered marketing that could help you claim part of that. But I would say overall, most entertainment expenses for like events like that are not going to be considered deductible.
Cool. All right, let's give it another minute. Got a lot of good questions. Oh. Here's another follow-up. If you aren't available, do you have friends we can hire?
I definitely actually do have a network of people that I know that are accountants. If anyone needs referrals, I could definitely look into it and see who would be a good fit.
Awesome. Cool. And what's the best way for folks to get in touch about that?
Yeah, you can email us at finance@rightsideup.co.
Cool. Great. And are most of your like colleagues and folks that you've worked with on the East Coast, like near where you live, Mark?
Yeah, I definitely know a few people in this area. But I stay in touch with a lot of CPAs and other accountants and financial professionals online, like as a part of some associations. So if you're looking for someone location specific, I can try and work with that too.
Cool. All right. Well, I think that is about it for questions, unless any more come in the last second here. But oh, you're the best, Mark. Oh, more compliments. This has been super helpful.
This has been great for my ego.
Connor says, I'll make sure to send the IRS your way. Connor. No, I'm so glad you guys can make it. Like I said at the start of this, I know this is something that a lot of consultants, especially first time and newer consultants, have questions about. It's complex. Mark, we appreciate you taking the time to walk everybody through it and answer some of the common questions we've heard over time. So thank you, Mark. Thank you for everyone who's joined us. And as we mentioned, we'll be sharing the recording via email within the next few days, so you have access to it.
Thank you.
Thanks, guys. Have a great day. Bye-bye.